Quick question. Two stocks. One trades at $10 a share, the other at $200. Which one is cheaper? If you said the $10 one, obviously, you just fell into the single most common trap in investing. And by the end of this video, you'll never make that mistake again. Because here's the wild part. Back in 2018, Amazon traded at a price-to-earnings ratio of 181. Today, around 28. Same company. It didn't shrink. It actually got bigger. So what changed? That's exactly what we're unpacking today. If you're brand new, welcome. This is the foundation. And if you've been investing for a while, this is the stuff that's worth getting crystal clear on, because most people skip it and then wonder why their portfolio is a mess. Here's my one ask. Don't just watch this. Apply it. Knowledge you never use doesn't make you a single dollar. Drop a comment with one thing you take away. I read them. Let's get into it. When you buy a share of stock, you are not buying a piece of paper or a blinking number on a screen. You're buying a slice of a real, living business and its profits. Think of a business as a money-making machine. Buy a share, and you own a piece of that machine. So before you buy anything, ask, how is this company sliced up? That number is called shares outstanding, the total number of shares that exist. Take McDonald's. Right now, it has roughly 710 million shares out there. A few years ago, it was up in the high 700 millions. So why fewer now? Because McDonald's keeps buying back its own shares and cancelling them, which means everyone else's slice quietly gets bigger. Companies can also do the opposite and print new shares. So this number isn't fixed. It breathes. If you owned 1 million McDonald's shares, you'd own about 0.14% of the whole company. Tiny, right? And honestly, unless you're holding millions of shares, your vote doesn't move anything. For most of us, we're buying to own a slice and ride along. In the US market, there's no minimum. You can buy a single share if you want. One more term, float. Shares outstanding is everything that exists. Float is what's actually available to trade, because founders and insiders often hold big blocks they'll never sell. Float is the stuff that's really in play. And a quick free tip, a site like FinViz shows all of this on a single page. So what is the stock market really? Strip away the jargon, and it's just a place to buy and sell pieces of public companies. It's not a building anymore. It's online, which means that from your couch, anywhere on the planet, you can own a piece of the best businesses in the world. I like to think of it as a giant supermarket of companies, on sale every single day at different prices. Some days they're expensive. Some days they go on discount. And those discount days, that's where opportunity lives. The beauty of this is that you get all the upside of owning a great business without the risk and headache of starting one. You can keep your job and still be an owner of Apple, Google, McDonald's, whatever you want. That's basically how Warren Buffett did it. He didn't found Coca-Cola or Apple. He bought them and he held on. Every Coke sold, every iPhone bought, quietly working for the shareholders. Now here's something that trips people up. For every buyer, there has to be a seller. And for every seller, a buyer. Always. The buyer thinks the price is going up. We call that bullish. The seller thinks it's going down. Bearish. And a trade only happens because these two people disagree. Think about that. If everyone was sure a stock was going to the moon, nobody would sell it to you. The whole market exists because of disagreement. It's a constant tug of war between bulls and bears, and whoever's stronger on a given day moves the price. More buyers than sellers, price goes up. More sellers than buyers, price goes down. A quick practical note. You want stocks that trade enough every day that you can get in and out easily. That's called liquidity. A rough floor is around 200,000 shares a day. The big names trade tens of millions, so it's basically never a problem with them. Okay, this next idea is the most important one in the whole video, so lean in. What moves a price up and down? Supply and demand, sure. But what drives that supply and demand depends entirely on your time frame. Long term, a stock follows the real value of the business, its sales, its profits, its cash flow. A good business grows its profits, becomes more valuable, and the price follows. Logical. We call studying this fundamental analysis short term. Short term is pure emotion, fear, and greed. A bad headline drops, everyone panics and sells, even if the business is totally fine. Good news hits, everyone gets greedy and piles in. We call studying that technical analysis, reading the trend, the mood. Let me show you both at once with Microsoft. Long term, elite business. Someone who bought around $200 in the early 2020s watched it climb past $550 by 2025. The business kept getting more valuable and the price followed. But, and this is the point, it was a brutal ride. It crashed in the 2022 bear market. And even recently, it dropped about 30% from that peak down to around 390. Same elite company. That whipsaw? That's emotion. Short-term fear and greed on full display. So to actually win, you need to answer two questions, not one. First, what is this stock actually worth? That's fundamentals. Second, what is the trend right now? That's technicals. Master both, and you've got an edge most investors never develop. Picture the true value of a company as a line. The price weaves above and below it, like a rubber band. When the price is below the value line, the stock is undervalued, so logically, it's a buy. You're getting a discount. When the price is above the line, it's overvalued. So logically, you avoid it or sell. You're overpaying. But here's the catch that fundamentals alone can't fix. In the short term, cheap can get cheaper and expensive can get even more expensive. Because emotion doesn't care what something's worth. A stock worth $42, trading at $39, can still drop to $30 if fear takes over. That's exactly why we add the trend. In an uptrend, you get higher highs and higher lows. The crowd is bullish, and the price tends to keep climbing. Technicals say, buy. In a downtrend, you get lower highs and lower lows. The crowd is bearish, and the price tends to keep falling. Technicals say, wait, or sell. Now the practical part. How do you quickly tell if a stock is cheap or expensive? Let me build it up. Imagine I'm selling a fast food that nets $1 million a year and it runs itself. What would you pay? Most people say 3 to 5 million, roughly 3 to 5 years to earn your money back. That multiple has a name. The price to earnings ratio. Price divided by earnings. Pay 3 million for $1 million in profit, and that's a PE of 3. But the second that fast food lists on the stock market, suddenly people will pay 15, 20, even 25 times earnings. Same restaurant. That re-rating is a huge reason companies want to go public. Now here's where 90% of beginners go wrong. They look at the PE ratio all by itself. Low PE good, high PE bad. And that's basically useless, because a PE means nothing until you compare it to how fast the company is growing. That gives you the ratio that actually matters, the PEG ratio. PE divided by the earnings growth rate. A PEG of around 1 means it's fairly priced. Under 1, it's undervalued. Over 1, it's getting pricey. And over about 1.6, it's too expensive. Sit it out. The rule of thumb I use, anything up to about 1.6 is still investable for a quality business. Above that, I wait. And here's something weird. Low PE stocks often keep falling because a low PE usually means low growth, while high PE stocks often keep rising because a high PE means investors are paying up for real growth. Growth is what you're really buying. So let's go back to our opening question. 2 stocks. Company A, $10 a share, a PE of 3, but earnings growing just 1% a year. Company B, $200 a share, a PE of 20 with earnings growing 50% a year. Which is cheaper? Pause and guess. Let's run the math. For company A, 3 divided by 1 is 3. A peg of 3. Wildly overvalued. For company B, 20 divided by 50 is 0.4. Clearly undervalued. So the $200 expensive stock is the real bargain. The price tag means nothing. The PE alone means nothing. PEG is the move. Let's pressure test this on real companies with current numbers as of mid-2026. Apple, around $290 a share with a PE of about 35. Back in 2018, it was a reasonable 19-ish. Today, the market pays a real premium for it, well above its own historical average. It's not the bargain it used to be. Amazon, our opening example. That insane PE of 181, now it's around 28. The profits finally caught up to the price, which proves a scary high PE can be justified if the growth actually shows up. McDonald's, about 285, with a PE around 23, right in that normal 15 to 25 band. A steady compounder, not a rocket ship. And that's perfectly fine. Notice the theme here. Amazon's PE went from 181 down to 28. Apple's went from 20 up to 35. Same companies, so the label cheap or expensive is a snapshot. Always rerun the numbers and reread the chart before you act. Now put valuation and trend together, and you get a simple cheat sheet. 4 scenarios. 1. Undervalued and in an uptrend. That's your sweet spot. You buy. 2. Undervalued but in a downtrend. You wait because cheap can get cheaper. 3. Overvalued and in a downtrend. You sell or avoid it because it's expensive and falling. And 4. Overvalued but in an uptrend. That's a short-term trade at most. And don't forget the option beginners always ignore. Doing nothing. Sitting in cash is a decision. You do not have to be invested every single day. Patience is a position. So how does a stock actually pay you? 2 ways. 1. Capital appreciation. You buy low, sell higher, and keep the difference. Buy at 320, sell at 502, and that's $182 a share in profit. 2. Dividends. Some companies hand you cash from their profits, usually every quarter. The yield is just the annual dividend divided by the price. $2 on a $20 stock is a 10% yield. As a rough guide, above 5% is generous. Who pays dividends? Mostly mature cash cow companies, like McDonald's, that can't reinvest all their cash, so they give it back. Fast growers, like Amazon in its growth years, pay nothing because every dollar goes straight back into growing. With those, you're betting on the price, not the payout. Last piece. The market's overall health gets tracked by indexes, baskets of representative stocks. The big 3 in the US are the Dow Jones, which is 30 iconic giants, the S&P 500, which is the 500 biggest US companies. That's the one everyone watches. And the NASDAQ Composite, which is everything listed on the NASDAQ. And here's the punchline that should keep you invested for life. Over the long run, the major indexes basically go up. Inflation, growth, and rebalancing all push markets higher, despite every crash along the way. The dot-com bust, 2008, the 2020 COVID crash, the 2025 tariff scare, all of it, and still higher. The S&P 500 was around 2,700 back in 2017. Today, about 7,600, more than double. And historically, just passively holding a broad index has returned roughly 10 to 12% a year. So here's the bar. Do nothing but hold the index, and you've historically made around 10 to 12% a year. That's your benchmark. The entire point of learning stock investing is to beat that. by picking quality companies that are undervalued and trending up. And that's where this series is headed. So let's lock it in. A share is part ownership of a real business. Long-term follows value. Short-term follows emotion. To judge cheap or expensive, use the PEG ratio, never the price or the PE alone. You can buy, sell, or do nothing, and all three are valid. Stocks pay you through price gains and dividends. Markets rise over the long run, around 10 to 12% a year. And your goal is to beat that. And never forget, every valuation is just a snapshot. Amazon going from a PE of 181 down to 28 is all the proof you need. If this made the stock market click for you, hit subscribe so you don't miss the next lesson. Smash that like button if the PEG ratio just changed the way you look at expensive stocks. And tell me in the comments, knowing what you know now, which is cheaper, a $10 stock or a $200 stock? Quick reminder, this video is for education only, and it is not financial advice. Every price and number here is approximate, and it will change over time. So always do your own research before you invest. I'll see you in the next one. Always keep learning, keep compounding.